Well, it has been a wild ride on Wall Street these last few weeks. The major stock market indices finished down on Friday, making January their worst month since May of 2012. So how should you position your portfolios? Our money man, Bob Ingram from Ameriprise Financial, is here with some advice. Always good to see you.
Thank you, Nu.
All right, so we're not starting off this year so well, are we?
No, not really. We've had a couple of tough weeks, certainly, with some news. Really, it's starting with emerging markets, international markets. A lot of investors have sort of moved some of the funds that have been, good return producers the last year or two, especially in the bond market and currencies. And some of those fears, of course, have kind of crept into the U.S. stock market, and at the same time we've seen a lot of money go into bonds again, just like in a lot of times when people move money from the risky stock things away from that, they'll flood that. And then of course you see some things in China that the manufacturing numbers are a little bit down. At the same time you have mixed earnings here in the U.S. where there's some perceived companies that missed, but as of last week you really had about 70% of the companies that reported earnings actually beat their estimates, and in the mid-60s, 65% or so actually beat on the revenues. So there are some decent things happening, but I think volatility is going to be here to stay for a little while.
So if we're reviewing our investments, our 401ks, should we be making certain changes or no?
Well, you really do have to look at the last 6 months to 8 months as an example of why being balanced is so important. And really, like the teams today that are going to be playing in the Super Bowl, you want to have different players on the field, so to speak, and positions in your portfolio that are going to have maybe some offense, if you will, and defense. And, it comes back to having the balance, really, depending on your risk tolerance. So, let's say a balanced portfolio, moderate risk, maybe 50% stocks and non-stocks. You want to have those nice things. You want to have, dividend and growth stocks for the growth part of it, for the longer term investing. You want to have, diverse bonds and cash for the protection aspect of things. So again, when markets go south like we've seen the last few weeks, those bonds and things can help keep you in the game, so to speak. And then also you want to look at things like overseas. Everything's not just in the U.S. A lot of portfolios have really ignored international exposure, both in stocks and in bonds, and there could be some good values there relative to the U.S. markets going forward there. And then also alternatives. You want to have things that are going to be doing, not going all the same direction by the same amount at the same time.
So what are some of the keys out there to managing your portfolio when you're dealing with volatility?
Well, you really have to look at your main goals and objectives, of course, and you've got to separate things that are that you need now. So short-term needs. If you're a retiree drawing income, we've talked about sort of segmenting the portfolio. You want to keep cash. You want to keep things that are not going to be as volatile in the market if you need them within a year or two or even 3. And then from the long-term investments, now you can take advantage of opportunities. That's the portfolio where you have a mix of investments, whether it's long-term stocks, diverse bonds, international investments, and so forth, and keep that there so it can ride out the ups and the downs. Then as you review, have your circumstances changed? Is your appetite for risk really not what it used to be? And then you make your adjustments to your allocation. And then as the markets change, really look at volatility as an opportunity. If stocks go down in your portfolio and you should be at 50% and now you're at 40%, you can increase those weightings back to your target and really be in a better position going forward. And again, when things are down, you can buy into those. When things are going up, you can sell and reduce those exposures, continue to do that in good efficiency.
Always a bit of a roller coaster ride, right?
That's right. But again, don't panic. Yeah. Just follow your plan. Very key.
Right. Thanks so much. Great advice as always. We'll see you next weekend. Malcolm, over to you.